I'm Sarah Borkson-Keeter with REIT.com. I'm here in New York for REIT Week 2017, REITs Investor Forum. I'm joined today by Stephen Marks, Managing Director at Fitch Ratings. Welcome, Stephen.
Thank you very much, Sarah, for having me.
So Fitch recently released a report looking at commercial bank borrowing by REITs. What were some of the main findings of the report?
Yeah, one thing we were looking at was the extent of bank borrowing exposure by the REIT sector. So we looked at the sum of draws on revolving lines of credit and outstanding term loans. And what we saw was that in comparing that total amount to the total amount of debt outstanding for REITs in the sector, and what we saw was that that number was around 10% at the end of 2009. That number is now around 18% as of the first quarter of 2017. And we understand why issuers are accessing the bank loan more. It's both a push and a pull. It's the banks pushing term loan product to REITs because they like funded outstandings. So it helps them from a capital charge perspective. And we also understand why REITs like to use term loans because one, cap rates are really low, so it's hard to buy things. It's also pretty challenging for companies to do new development because they want to keep a lid on development exposure. And to the extent that REITs are generating, call it 2 or 3% organic growth, all that said, it's hard to grow organically when you consider all those things. So companies are looking to find ways to earn a penny here, a penny there on earnings. And one way to do that is to reduce the cost of funding or financing. And so to the extent that a term loan acts as essentially as a surrogate to an unsecured bond, and those are priced, call it 150 to 200 basis points tighter than a 10-year bond offering, that's a way for issuers to sort of find earnings and overall improve their cash flow on the margin.
And turning to the retail sector, do you feel that REITs have responded adequately to changing consumer preferences?
For the REITs, we generally think that the retail REITs are doing the right thing. They are ensuring that that location is relevant for both consumers and for tenants. So typically, to the extent that it's a well-located center, with good demographics and household income, that generally it's easier for some REITs to make the case that that center is relevant. That's a place that customers want to go to, and it's a place that tenants want to be at. So for some locations it's easier, just given the locations. For some it's harder. So to the extent that some of the REITs need to invest more capital in some of these assets, that's probably what they'll need to do to make sure that that location maintains some relevance.
And industrial REITs were among the strongest performers last year. Do you see more room for growth in that sector?
We definitely do. It's finally industrial's day in the sun. And certainly a lot of that has been driven by, there's been very strong supply that's come on. However, that's been taken up by pretty robust absorption. So occupancies are actually going up on the margin. The biggest driver of that trend of improving fundamentals in industrial has been e-commerce. And we don't see that abating anytime soon. So the one thing where we might be a little bit concerned is to the extent that any of the potential policies that could be enacted by this administration could put a lid or reduce trade. That could have negative implications on some of the coastal gateway markets. But again, that would be more so on the margin and fairly far out in terms of any of those implications.
Great. Well, thank you very much, Stephen.
Yep, thank you.
And for more on REIT Week 2017, be sure to visit REIT.com.